Good afternoon, everyone. It's Thursday, the 2nd of May, 2013, and we have new highs once again in the S&P 500 as the buyers just continue to show up here. The key to focus on is the same thing that we always focus on. I really see a lot of frustration amongst even some close friends who I consider to be good traders who are fighting this rally right now and saying that, well, look at the volume. The volume is so light and that, it's being propped up by the Fed and the market is essentially wrong, is the argument here. But the fact is, we continue to make higher highs and higher lows. Technical Analysis 101 says an uptrend is higher highs and higher lows, nor does it say anything about the volume. We have to be aware, of course, that the market is getting extended and maybe what some people call in nosebleed territory, and it's coming with less fuel. So that leaves it vulnerable for when it does get cracked again, that it might get cracked a little bit harder. But the problem is that when we have this type of environment, it builds up the complacency of a lot of participants. That is, they think, well, shoot, the last time I got scared, I sold at this point or that point, and it came right back. And they say, now, from now on, I'm going to hold. I'm going to stay with this market longer. It always seems to come back. Therefore, they let their guard down, get sloppy and complacent. And then the time when it doesn't come back, they're still stuck with it and end up buying more, trying to average down in a downtrend. We still have a rising 50-day moving average. That's a fact. And as long as we have a rising 50-day moving average, the benefit of the doubt does go to the buyers. We want to be aware of who has control. What's the path of least resistance? It's clearly higher. Our primary focus this week was about this 158 level, saying that as long as we held above this level, that we were going to continue to give the benefit of the doubt intermediate term to the buyers. Yesterday we spoke about the fact that it looked like that level was going to be tested and it could possibly lead to a bigger pullback, but we still were going to give the benefit of the doubt to the buyers because we're in a primary uptrend, and that was the correct thing to do. As the buyers came back in today, the market gapped up. It hung around the 2-day volume weighted average price, and then we saw just a couple of real nice pushes higher throughout the day as the market remained above the daily volume weighted average price for the entire session. Looking at the NASDAQ, we had higher highs in here as well. I've been talking about how it doesn't make sense to be chasing this market, that we're extended and that you don't want to be the breakout buyer, just like you didn't want to be the person who bought this low. That is, you don't want to buy after the market gets extended unless you're doing it for shorter term time frames. Now, of course, we've seen this market continues to get to rally, and you could say, well, Brian, you were wrong about that. I did buy that breakout and you made money, and I would say you did this time. But what happened the last few times when the market broke out? What was the subsequent action there? And you have to maintain a high discipline if you're going to. We focused this week earlier on this $70 level. On Monday, I was telling subscribers this is the key level for the week. We want to see it hold above 69 and a half. I'm sorry, 70, and below that, of course, we had this bigger level. But 70 became the focus on Tuesday, and that's where we've continued to see this pattern of higher highs and higher lows. You can say, well, it broke that trend, that upper trend line, or whatever. But the fact is, higher highs and higher lows, whether they're occurring on heavy volume or light volume, are going to bring money into your account if you're long, and they're going to show you losses if you're short. There will be some kind of catalyst that scares this market, and you have to say, as the market becomes more extended in here, you want to reduce your exposure. That is, if you've got stocks that are up a lot, you want to raise the stops, pull back a little bit, maybe sell half of your position. How you manage money and risk is up to you. It does not have to end badly. The market simply does not have to end badly if you have discipline. We've been talking about the Russell 2000. The big level of importance is way down now at 88.5. We saw a test of that last week. We were looking at potentials for head and shoulders patterns and that sort of thing. But the fact is, the market is now in a bigger range, and realistically, this range, we tested the midpoint of it yesterday, but it goes from about 88.5 up to about this 90, 80, 80, I'm sorry, 94.5 to 95. We're still within this range, and until it breaks that range, we're really just, you have to look at it and say we're consolidating within this uptrend. We're correcting through time. We're not in a bear market in the Russell 2000. Getting a pattern of lower highs and lower lows below a declining 50-day moving average after breaking a key level of support, that is what is your clue that now the market is in control by sellers. Right now it's not in control by sellers. The daily time frame, it's a real battle in here, but because we still have a rising 50, 100, 150 and 200-day moving average, the odds favor further upside in here, just as they have for the semiconductors, which broke important support at 36 last week, and we continue to ramp higher. I've thought this market is extended, but if you were going to trade it, that this week the key level of focus as far as support was at about 36 and a dime, and we've made higher highs and higher lows since then. So if you're long this market right now and concerned, then you have to look at it and say which one of these higher lows is more important for you personally. If it breaks below this 36.80, are you going to say, okay, enough's enough, I'm going to take my profits? Or are you going to wait till the higher low on a bigger time frame, such as 36? Those are personal decisions. Everyone has to be aware of their own personal time frame. It's not universally. You can't tweet something out and say, that I'm bullish. You're bullish on what time frame? Or you're bearish. You're bearish on what time frame? But clearly, whatever time frame it is you might be bearish on for the semiconductors or any of these markets is, the market disagrees with you, and you're not going to usually come up on the winning side of that battle. The financials, they're still poised to hit $20 a share at some point. Whether we make it on this run or not is not for me to guess, but we do have a key level of support that we want to see continue to hold up. That is the 1840 to 1850 area. This level has been what we've been focused on and what we should continue to focus on as far as support goes. We have a rising 20-day moving average in there. So even if we get a pull back tomorrow down towards this level, it's not going to end this rally. It might be the end of the rally. It might be the ultimate top, but you simply can't identify that tomorrow with any accuracy whatsoever. If you call a top on this day and 6 months from now you can say, hey, I was right, well, you got lucky basically, because people have been calling tops the whole way up here and the market continues to defy that. So again, the lesson as always is listen to price. Only price pays.